Truth in Lending Act, TILA, Core Requirements. What is the primary purpose of the Truth in Lending Act as defined by federal law? Is it A, to ensure consumers receive clear information about credit terms and costs? B, to regulate the interest rates that lenders can charge? C, to provide government loans to first-time homebuyers? Or D, to enforce criminal penalties for late loan payments? The correct answer is A, to ensure consumers receive clear information about credit terms and costs. The Truth in Lending Act was enacted to promote the informed use of consumer credit by requiring disclosures about its terms and cost, enabling consumers to compare credit terms more easily and knowledgeably. Which of the following transactions is not generally covered by the Truth in Lending Act? Is it A, a personal auto loan for a family vehicle? B, a commercial loan for purchasing office equipment? C, a credit card issued to an individual for personal use? Or D, a home equity line of credit for home improvements? The correct answer is B, a commercial loan for purchasing office equipment. Why this can be tricky. TILA covers most consumer credit, but excludes certain transactions, such as business or commercial loans. Some may mistakenly believe all loans are covered, but business purpose credit is not. Maria applies for a personal loan at her local bank, and the lender provides her with a disclosure outlining the loan's annual percentage rate and total finance charges. What requirement of the Truth in Lending Act does this fulfill? Is it A, it fulfills the requirement to verify Maria's income? B, it fulfills the requirement to report the loan to credit bureaus? C, it fulfills the requirement to disclose key credit terms and costs to the consumer? Or D, it fulfills the requirement to provide a free credit report to Maria? The correct answer is C, it fulfills the requirement to disclose key credit terms and costs to the consumer. This scenario demonstrates TILA's requirement that lenders provide clear disclosures of credit terms, including the annual percentage rate and finance charges, to help consumers make informed decisions. Finance charge definition and inclusions. Which of the following is generally included in the finance charge under the Truth in Lending Act for a closed-end loan? Is it A, interest charged on the loan amount? B, title insurance premium? C, seller's attorney fee? Or D, property tax payment? The correct answer is A, interest charged on the loan amount. A finance charge under TILA includes fees and costs that are directly related to obtaining credit, such as interest, points, and certain loan fees. It does not include fees for services like title insurance or appraisal if they are bona fide and reasonable. Which fee is not considered part of the finance charge under TILA, even if paid directly to the lender? Is it A, loan origination fee? B, application fee charged to all applicants? C, prepaid interest? Or D, discount points? The correct answer is B, application fee charged to all applicants. Why this can be tricky. Some fees paid to the lender, like application fees, are not finance charges if they are charged to all applicants regardless of credit approval. This can be confusing because many assume all lender fees are included.
How'd you do on the first 5 questions? Go ahead and subscribe to Birdsey now and turn your progress into exam day confidence. Ready to jump back in? Let's go.
Maria is obtaining a mortgage and pays for an appraisal, credit report, and loan origination fee. Which of these charges must be included in the finance charge disclosed to her under TILA? Is it A, appraisal fee only? B, credit report fee only? C, loan origination fee only? Or D, all 3 fees? The correct answer is C, loan origination fee only. The loan origination fee is included in the finance charge, while bona fide and reasonable appraisal and credit report fees are excluded. TILA requires only certain charges directly related to the cost of credit, to be disclosed as finance charges. Annual percentage rate terminology. Which term best describes the annual percentage rate as required to be disclosed under the Truth in Lending Act? Is it A, the cost of credit expressed as a yearly rate, including certain fees? B, the total amount financed over the life of the loan? C, the interest rate charged on the principal balance only? Or D, the monthly payment amount required by the lender? The correct answer is A, the cost of credit expressed as a yearly rate, including certain fees. The annual percentage rate, or APR, is a standardized measure of the cost of credit expressed as a yearly rate, including interest and certain fees, as required by TILA for consumer protection and comparison purposes. Which of the following is not included when calculating the annual percentage rate under the Truth in Lending Act? Is it A, prepaid interest, B, loan origination fee, appraisal fee, or D, mortgage insurance premium paid upfront? The correct answer is C, appraisal fee. Why this can be tricky. Some fees, like appraisal fees, are not included in the APR calculation, while others, such as prepaid interest and origination fees, are. It's important to distinguish between finance charges and other closing costs. Maria is reviewing her loan estimate and notices the annual percentage rate is higher than the interest rate. What does this difference indicate about her loan costs? Is it A, she is being charged a penalty for early repayment? B, additional fees and costs are included in the APR calculation? C, the interest rate will increase after the first year? Or D, her monthly payment will be higher than disclosed? The correct answer is B, additional fees and costs are included in the APR calculation. The APR is higher than the interest rate because it reflects not only the interest, but also certain fees and costs associated with the loan, giving Maria a more complete picture of the true cost of borrowing. Material disclosures under TILA. Which of the following is always required to be disclosed as a material term under the Truth in Lending Act for closed-end credit transactions? Is it A, the annual percentage rate, B, the borrower's credit score, C, the lender's profit margin, or D, the appraised value of the property? The correct answer is A, the annual percentage rate. The Truth in Lending Act requires disclosure of the annual percentage rate as a material term for closed-end credit transactions, ensuring consumers understand the true cost of borrowing.
If you want more than just rapid-fire questions, head over to birdsy.ai. You can take unlimited practice exams and get instant help from your personal AI study partner. It's like having a tutor 24/7. Try it free. You'll find a link in the description.
Which statement about material disclosures under TILA is not correct? Is it A, the finance charge must be disclosed? B, the borrower's employment history must be disclosed? C, the total amount financed must be disclosed? Or D, the payment schedule must be disclosed? The correct answer is B, the borrower's employment history must be disclosed. Why this can be tricky. The question asks for the incorrect statement. TILA does not require disclosure of the borrower's employment history as a material term, while the other items are required or related to required disclosures. A lender provides a borrower with a Truth in Lending disclosure that omits the total finance charge but includes all other terms. What is the regulatory consequence under TILA? Is it A, the loan is automatically rescinded? B, no consequence if the borrower does not complain? The lender is in violation of TILA and may face penalties? Or D, the borrower must pay a higher interest rate? The correct answer is C. The lender is in violation of TILA and may face penalties. Omitting the finance charge is a violation of TILA's material disclosure requirements, which can result in civil liability and regulatory enforcement actions against the lender. Right of rescission, rules, and timeframes. Under the Truth in Lending Act, how many business days does a borrower have to exercise the right of rescission after closing on a refinance of their principal residence? Is it A, 1 business day, B, 3 business days, C, 7 calendar days, or D, 10 business days? The correct answer is B, 3 business days. The Truth in Lending Act gives borrowers 3 business days to rescind certain credit transactions secured by their principal dwelling, such as a refinance. This period begins after closing and after receiving all required disclosures and the notice of the right to rescind. Which of the following transactions is not subject to the Truth in Lending Act's right of rescission rules? Is it A, a refinance of a home equity loan on a primary residence, B, a home improvement loan secured by the borrower's principal dwelling, C, a loan used to purchase a new principal residence, or D, a refinance with a new lender on a borrower's primary home? The correct answer is C, a loan used to purchase a new principal residence. Why this can be tricky. Not all loans secured by a home qualify for rescission. The right does not apply to purchase money mortgages, only to certain refinances and home equity loans on a principal dwelling. Maria closes on a home equity line of credit for her main home on a Friday and receives all required disclosures. By what day must she notify the lender if she wants to rescind the loan? Is it A, Friday, B, Saturday, C, Monday, or D, Tuesday? The correct answer is D, Tuesday. The rescission period is 3 business days after closing and receipt of disclosures. If Maria closes on Friday, she has until midnight on Tuesday to rescind, assuming no federal holidays intervene. After closing a refinance on his primary residence, John realizes he did not receive the required notice of right to rescind. How long does he have to rescind the transaction under TILA? Is it A, up to 3 years from closing, B, 30 days from closing, C, until the first payment is due, or D, only until the end of the next business day? The correct answer is A, up to 3 years from closing. If the required notice is not provided, the right to rescind extends up to 3 years from closing, not just 3 business days. This protects consumers from incomplete disclosures.
Have you noticed the code in the bottom corner? The next time you're stumped, take that code to birdsey.ai. You'll get immediate help, complimentary study sessions, and access to hundreds of additional questions. It's the best tool to help you pass with confidence.
Advertising requirements under Regulation Z. Which of the following is considered a triggering term under the Truth in Lending Act's advertising requirements for closed-end credit? Is it A, low monthly payments, B, 10% down payment, C, easy approval process, or D, no prepayment penalty? The correct answer is B, 10% down payment. A triggering term is a specific credit term, such as the amount of down payment, that requires additional disclosures under Regulation Z. Mentioning the amount of down payment is a classic example of a triggering term. A lender's online ad for a home equity loan states only $500 per month, but provides no other details. According to Regulation Z, what must the lender also disclose in this advertisement? Is it A, the lender's contact information only, B, the total interest paid over the life of the loan only, C, the loan amount, annual percentage rate, and terms of repayment, or D, the borrower's credit score requirements only? The correct answer is C, the loan amount, annual percentage rate, and terms of repayment. Stating a specific payment amount is a triggering term, so Regulation Z requires the lender to also disclose the loan amount, annual percentage rate, and terms of repayment in the advertisement. Real Estate Settlement Procedures Act, RESPA, Core Requirements. Purpose and scope of RESPA. What is the primary purpose of the Real Estate Settlement Procedures Act in real estate transactions? Is it A, to protect consumers by requiring disclosures and prohibiting kickbacks? B, to regulate interest rates on mortgage loans? C, to determine property values for tax purposes? Or D, to enforce building codes in residential construction? The correct answer is A, to protect consumers by requiring disclosures and prohibiting kickbacks. RESPA was enacted to ensure consumers receive disclosures about settlement costs and to prohibit abusive practices, such as kickbacks, that can increase the cost of settlement services. Which of the following transactions is not covered by the Real Estate Settlement Procedures Act? Is it A, a loan to purchase a single-family home using a federally related mortgage? B, a commercial property sale with no mortgage involved? C, a refinance of a residential mortgage loan? Or D, a home equity line of credit on a primary residence? The correct answer is B, a commercial property sale with no mortgage involved. Why this can be tricky. RESPA covers most federally related mortgage loans, but it does not apply to all cash sales, rental property transactions, or commercial property sales, which can be easily overlooked. Maria is purchasing her first home, and her lender provides her with a loan estimate and closing disclosure. Under RESPA, why must these documents be given to her? Is it A, to ensure the lender receives payment on time? B, to allow the seller to review the buyer's financial status? C, to inform the borrower of settlement costs and prevent surprises at closing? Or D, to comply with state tax reporting requirements? The correct answer is C, to inform the borrower of settlement costs and prevent surprises at closing. RESPA requires lenders to provide these disclosures so borrowers like Maria can understand settlement costs and compare loan offers, promoting transparency and protecting consumers from unexpected fees. Section 8. Prohibited kickbacks and unearned fees. Which of the following is prohibited under Section 8 of the Real Estate Settlement Procedures Act regarding settlement service referrals? Is it A, paying a real estate agent for referring a client to a title company? B, charging a reasonable fee for actual settlement services performed? C, disclosing affiliated business arrangements to clients? Or D, providing a list of recommended service providers without compensation? The correct answer is A, paying a real estate agent for referring a client to a title company. Section 8 of RESPA prohibits giving or accepting any fee, kickback, or thing of value for the referral of settlement service business related to a federally related mortgage loan. Which statement about unearned fees under RESPA Section 8 is not correct? Unearned fees are prohibited even if both parties are licensed. B, splitting fees for services not actually performed violates Section 8. C, a lender may pay a fee to a real estate agent for referring a borrower if both disclose the payment. Or D, Section 8 applies to federally related mortgage loans. The correct answer is C. A lender may pay a fee to a real estate agent for referring a borrower if both disclose the payment. Why this may be tricky? The question asks for the incorrect statement, and some options may sound plausible. RESPA prohibits splitting fees for services not actually performed, even if both parties are licensed or affiliated. A mortgage broker offers a home inspector a $100 gift card for every client referred who completes an inspection, and the inspector accepts. Does this arrangement violate RESPA Section 8? Is it A, yes, because it is a prohibited kickback for referrals? B. No, because the payment is a gift card and not cash. No, if the clients are informed in writing about the arrangement. Or D. Yes, but only if the inspector is not licensed. The correct answer is A. Yes, because it is a prohibited kickback for referrals. This scenario describes a clear violation of Section 8, which prohibits giving or accepting anything of value in exchange for the referral of settlement service business. A title company pays a real estate agent a fee for each client who uses their closing services, but the agent performs no additional work. Does this comply with RESPA Section 8? Is it A. Yes, because the agent is licensed to receive such fees. B. Yes, if the fee is disclosed to the client. C. No, unless the agent performs additional settlement services. Or D. No, because the agent did not perform any actual settlement services. The correct answer is D. No, because the agent did not perform any actual settlement services. Paying a fee for referrals without actual services performed is a violation of Section 8, which prohibits unearned fees and kickbacks in connection with settlement services. Affiliated business arrangement disclosure requirements. What must an affiliated business arrangement disclosure include under RESPA requirements? Is it A. Only the estimated charges for the referred service provider? B. A list of all affiliated companies in the real estate transaction? C. The nature of the relationship, estimated charges, and a statement that use of the provider is not required? Or D. A copy of the service provider's license? The correct answer is C. The nature of the relationship, estimated charges, and a statement that use of the provider is not required. The disclosure must clearly describe the nature of the relationship, provide an estimate of charges, and inform the consumer that they are not required to use the referred service provider. Which of the following is not required in an affiliated business arrangement disclosure under RESPA? Is it A. A statement that the consumer is not required to use the referred provider? B. A list of all employees working at the affiliated business? C. An estimate of the charges generally made by the provider? Or D. A description of the nature of the business relationship between the parties? The correct answer is B. A list of all employees working at the affiliated business. Why this can be tricky? The question asks for what is not required, and some options sound plausible. RESPA does not require a list of all employees of the affiliated business, only information about the relationship, charges, and consumer choice. A real estate agent refers a buyer to a title company in which the agent's brokerage has an ownership interest and provides the buyer with a written disclosure describing the relationship and estimated charges, but does not state that the buyer is free to choose another provider. Is this disclosure compliant with RESPA? Is it A. Yes, because the relationship and charges are disclosed? B. Yes, as long as the buyer signs the disclosure? C. No, because the estimated charges were not itemized? Or D. No, because the disclosure must state the buyer is not required to use the referred provider? The correct answer is D. No, because the disclosure must state the buyer is not required to use the referred provider. The disclosure is not compliant because RESPA requires a clear statement that the consumer is not obligated to use the referred provider, in addition to describing the relationship and charges. Escrow account limitations and annual statements. What is the maximum amount a lender may require a borrower to maintain in an escrow account under RESPA requirements? Is it A. 6 months of escrow payments? B. No cushion is allowed at all? C. 2 months of escrow payments, plus the amount needed for bills? Or D. 1 year of escrow payments? The correct answer is C. 2 months of escrow payments, plus the amount needed for bills. RESPA limits the amount a lender can require in an escrow account to cover taxes and insurance. The maximum cushion is typically 2 months of escrow payments, plus the amount needed to pay upcoming bills. Which of the following is not required to be included in the annual escrow account statement provided to borrowers under RESPA? Is it A, the amount of taxes paid from the account? B, the borrower's credit score? C, the projected payments for the coming year? Or D, the account balance at the end of the period? The correct answer is B. Why this can be tricky. The annual escrow statement must include projections, payments, and account activity, but it does not require disclosure of the borrower's credit score, which is unrelated to escrow management. Maria receives her annual escrow account statement from her lender and notices it lists a surplus in her account. According to RESPA, what must the lender do if the surplus exceeds the allowed cushion? Is it A, refund the surplus amount to Maria? B, apply the surplus to the next year's escrow payments without notifying Maria? C, increase Maria's monthly escrow payment? Or D, transfer the surplus to a reserve account for lender use? The correct answer is A, refund the surplus amount to Maria. If the surplus in the escrow account exceeds the allowed cushion, RESPA requires the lender to return the excess amount to the borrower within a specified time frame, unless the surplus is less than $50 and the lender chooses to apply it to future payments. Servicing transfer disclosure requirements. Under RESPA, when a mortgage loan is transferred to a new servicer, what is the required time frame for the borrower to receive a servicing transfer disclosure from the new servicer? Is it A, within 15 days of the transfer? B, at least 30 days before the transfer? C, within 15 days after the transfer? Or D, no later than 60 days after the transfer? The correct answer is C, within 15 days after the transfer. RESPA requires that the new servicer provide a servicing transfer disclosure to the borrower within a specific period after the transfer. This ensures borrowers are informed about where to send payments and who to contact for servicing issues. Maria receives a notice that her mortgage servicing is being transferred to a new company and wants to know if she can be charged a late fee if she accidentally sends her payment to the old servicer during the first 60 days after the transfer. Is it A, yes, the new servicer can charge a late fee immediately? B, no, RESPA prohibits late fees for payments sent to the old servicer within 60 days. C, only if the payment is more than 30 days late. Or D, it depends on the terms of the original loan agreement. The correct answer is B, no, RESPA prohibits late fees for payments sent to the old servicer within 60 days. RESPA protects borrowers from late fees or negative credit reporting if they mistakenly send payments to the old servicer within 60 days after a servicing transfer, as long as the payment is received on time. TRID purpose and scope of coverage. Which type of loan transaction is generally covered by the TRID rule for integrated disclosures? Is it A, a closed-end mortgage loan for a home purchase? B, a home equity line of credit? C, a reverse mortgage? Or D, a loan secured only by a mobile home not attached to land? The correct answer is A, a closed-end mortgage loan for a home purchase. The TRID rule applies to most closed-end consumer credit transactions secured by real property, such as typical home purchase mortgages. It does not apply to home equity lines of credit, reverse mortgages, or loans secured by mobile homes not attached to land. Which of the following is not excluded from TRID coverage under the CFPB's rules? Is it A, a reverse mortgage? B, a home equity line of credit? C. A standard closed-end mortgage for a primary residence. Or D. A loan secured by a vacant lot. The correct answer is C. A standard closed-end mortgage for a primary residence. Why this is tricky. The question asks for the exception to the exclusions. Most people focus on what is excluded, but the correct answer is a standard purchase mortgage, which is actually covered by TRID. Maria is applying for a closed-end mortgage to buy a single-family home. Which federal rule requires the lender to provide her with integrated disclosures about the loan's terms and costs? Is it A, the Fair Credit Reporting Act, B, the TRID rule, C, the Equal Credit Opportunity Act, or D, the Homeowners Protection Act? The correct answer is B, the TRID rule. The TRID rule, issued by the CFPB, requires lenders to provide integrated disclosures for most closed-end consumer mortgage loans, including home purchases like Maria's. Loan estimate delivery timing requirements. According to the TRID rule, when must a creditor provide the loan estimate to a consumer after receiving a loan application? Is it A, within 1 business day, B, within 3 business days, C, within 5 business days, or D, by the date of loan consummation? The correct answer is B, within 3 business days. The TRID rule requires the loan estimate to be delivered or placed in the mail no later than 3 business days after the creditor receives a consumer's loan application. Which of the following actions allows a creditor to delay providing the loan estimate beyond the required timeframe under the TRID rule? Is it A, waiting for the consumer to select a property, B, requesting additional income documentation from the consumer, C, none of these actions allow a delay, or D, waiting for the consumer to lock the interest rate? The correct answer is C. None of these actions allow a delay. Why this can be tricky. The TRID rule does not permit creditors to delay the loan estimate for reasons such as waiting for additional documentation or a property address. Once the application is complete, the 3 business day clock starts, regardless of other factors. Maria submits a completed loan application to her lender on a Wednesday. By what day must the lender deliver or mail the loan estimate, according to TRID requirements? Is it A, Saturday, B, Monday, C, Friday, or D, the following Wednesday? The correct answer is A. Since Maria applied on Wednesday, the lender must deliver or mail the loan estimate no later than 3 business days later, which would be Saturday, assuming no federal holidays intervene. A broker receives a consumer's completed loan application on a holiday and forwards it to the creditor the next business day. When does the 3 business day period for delivering the loan estimate begin under TRID? On the holiday when the broker received the application. B, the day after the broker receives the application. 3 business days after the broker receives the application. Or D, the day the creditor receives the application from the broker. The correct answer is D, the day the creditor receives the application from the broker. The 3 business day period begins when the creditor receives the application, not when the broker receives it. Holidays do not count as business days for delivery timing. Closing disclosure delivery timing requirements. According to the TRID rule, how many business days before consummation must the closing disclosure be provided to the consumer? Is it A, 3 business days, B, 5 business days, C, 1 calendar week, or D, on the day of closing? The correct answer is A, 3 business days. The TRID rule requires that the closing disclosure be delivered to the consumer at least 3 business days before consummation of the loan. This timing ensures the borrower has adequate time to review the terms and costs. Which of the following statements about closing disclosure delivery timing is not correct under the TRID rule? Is it A, the closing disclosure must be provided at least 3 business days before consummation? B, the closing disclosure can be delivered after consummation if the borrower agrees in writing? C, if the closing disclosure is mailed, it is considered received 3 business days after mailing? Or D, a revised closing disclosure may require a new 3 business day waiting period in certain cases? The correct answer is B. The closing disclosure can be delivered after consummation if the borrower agrees in writing. Why this can be tricky? The question asks for the incorrect statement, so you must identify which option does not align with TRID requirements. Some options may sound plausible, but do not reflect the actual rule. Maria is scheduled to close on her home purchase on Friday and receives her closing disclosure on Tuesday. According to TRID, is this timing compliant? Is it A? No, because the disclosure must be delivered 4 business days before closing. B. No, because the disclosure must be delivered on the same day as closing. C. Yes, because the disclosure was delivered 3 business days before closing. Or D. Yes, but only if the lender provides a verbal explanation as well. The correct answer is C. Yes, because the disclosure was delivered 3 business days before closing. Maria receives the closing disclosure 3 business days before her scheduled Friday closing, which satisfies the TRID requirement for delivery timing before consummation.
Did you get a different answer? Or maybe you have a question about the exam in general? Drop it in the comments below. We read and answer them personally.
Revised loan estimate and redisclosure triggers. What event requires a lender to provide a revised loan estimate under the TRID rule if it causes the estimated charges to increase beyond the applicable tolerance limits? Is it A, a borrower requests a copy of their credit report? B, a borrower decides to change the loan product after the initial loan estimate is provided? C, the lender corrects a minor typographical error in the loan estimate? Or D, the borrower asks for a lower interest rate without changing loan terms? The correct answer is B. A borrower decides to change the loan product after the initial loan estimate is provided. A changed circumstance that affects settlement charges beyond tolerance limits requires a revised loan estimate under the TRID rule. This ensures borrowers receive accurate disclosures when significant changes occur after the initial estimate. Which of the following does not require the lender to issue a revised loan estimate under the TRID rule? B, the borrower changes the property address after the initial loan estimate. C, the lender corrects the borrower's name from John to John on the loan estimate. Or D, the borrower requests a higher loan amount after the initial loan estimate. The correct answer is C. The lender corrects the borrower's name from John to John on the loan estimate. Why this can be tricky? Not all changes require redisclosure. Only changes that affect settlement charges or loan terms beyond tolerance thresholds require a revised loan estimate. A lender correcting a misspelled name does not trigger redisclosure. After receiving a loan estimate, Maria decides to switch from a fixed rate to an adjustable rate mortgage, and her lender must determine what action to take under the TRID rule. What must the lender do? Is it A, issue a revised loan estimate reflecting the new loan terms? B, do nothing and proceed with the original loan estimate? C, only update the closing disclosure at settlement? Or D, cancel the application and require Maria to reapply? The correct answer is A. Issue a revised loan estimate reflecting the new loan terms. Switching loan products is a changed circumstance that requires the lender to issue a revised loan estimate to reflect new terms and costs, ensuring Maria receives accurate and timely disclosures as required by the TRID rule. tolerance categories, and cure provisions. Which category of fee under the TRID rule allows for a zero tolerance for increases between the loan estimate and closing disclosure? Is it A, lender-imposed origination charges, B, prepaid interest, C, homeowners insurance premiums, or D, title insurance selected by the borrower? The correct answer is A, lender-imposed origination charges. Zero tolerance fees under the TRID rule include lender fees and fees paid to affiliates or required third parties. These fees cannot increase from the loan estimate to the closing disclosure, ensuring consumer protection against unexpected costs. Which of the following statements about the timing of the closing disclosure under the TRID rule is not correct? Is it A, it must be provided at least 3 business days before closing? B, it can be delivered electronically if the consumer consents? C, it may be provided on the day of closing if the consumer waives the waiting period? Or D, it must reflect all known changes since the loan estimate? The correct answer is C. It may be provided on the day of closing if the consumer waives the waiting period. Why this can be tricky? The closing disclosure must be provided at least 3 business days before closing, not on the day of closing. Some may confuse this with other disclosures or overlook the required waiting period. A borrower receives a loan estimate showing a $500 appraisal fee, but the closing disclosure lists the fee as $650 due to a required rush order. What must the lender do to comply with TRID tolerance and cure provisions? Is it A, do nothing, as the change was due to a rush order requested by the borrower? B, refund the $150 difference to the borrower within the required time frame? C, issue a revision of the loan estimate after closing to reflect the new fee? Or D, disclose the change in a post-closing addendum only? The correct answer is B, refund the $150 difference to the borrower within the required time frame. Because the appraisal fee is a zero-tolerance item, any increase must be cured by the lender refunding the excess amount to the borrower within the required time frame to comply with TRID. Definition of application under TRID. Which of the following is required for a loan application to be considered complete under the TRID rule definition of application? Is it A, the consumer's employment history, B, the property address, C, the interest rate requested, or D, the down payment amount? The correct answer is B, the property address. A complete application under TRID requires 6 specific pieces of information: the consumer's name, income, social security number, property address, estimated property value, and the loan amount sought. A borrower provides their name, income, social security number, property address, estimated property value, and loan amount sought to a lender on a Monday. By what day must the lender deliver the loan estimate under TRID? Is it A, the same day the information is received? B, within 1 business day? C, within 3 business days? Or D, within 7 calendar days? The correct answer is C, within 3 business days. The lender must provide the loan estimate within 3 business days of receiving the 6 required pieces of information that constitute a complete application under TRID. Ability-to-Repay and qualified mortgage standards. Ability-to-repay factors and verification requirements. Which of the following is a required factor that lenders must consider when determining a borrower's ability to repay a mortgage loan? Is it A, current or reasonably expected income or assets? B, the borrower's preferred loan term? C, the real estate agent's commission? Or D, the appraised value of neighboring properties? The correct answer is A, current or reasonably expected income or assets. Lenders must consider the borrower's current or reasonably expected income or assets as one of the required factors under the Ability-to-Repay rule. This ensures the borrower can make the scheduled payments on the loan. Which of the following is not a verification requirement under the Ability-to-Repay rule for qualified mortgages? Is it A. Verification of current employment status, B. Verification of marital status, C. Verification of monthly debt obligations, or D. Verification of income using reliable third-party records? The correct answer is B. Verification of marital status. Why this can be tricky? The Ability-to-Repay rule requires verification of income, assets, employment, and debts, but not the borrower's marital status. Marital status may affect other aspects of lending, but is not a required verification item for this rule. A lender is reviewing Maria's mortgage application and notices she has variable income from seasonal work. What must the lender do to comply with Ability-to-Repay verification requirements? Is it A. Approve the loan based on Maria's stated income only, B. Rely solely on Maria's most recent pay stub, obtain and review third-party documentation of Maria's income history, or D. Ignore income verification due to the seasonal nature of her work? The correct answer is C. Obtain and review third-party documentation of Maria's income history. The lender must verify Maria's income using reasonably reliable third-party records, even if her income is variable, to ensure she can repay the loan according to the Ability-to-Repay rule. Qualified mortgage criteria and limitations. Which of the following is a requirement for a loan to be considered a qualified mortgage under the Ability-to-Repay rule? Is it A. The loan must allow for negative amortization, B. The loan must have an interest-only payment period, or D. The loan must have a term longer than 40 years? The correct answer is C. The loan must verify the borrower's income and assets. A qualified mortgage must not have risky features such as negative amortization, interest-only payments, or balloon payments, and must verify the borrower's ability to repay using documented income and assets. Which of the following statements about qualified mortgage limitations is not accurate? Is it A. Qualified mortgages cannot have interest-only features, B. Balloon payments are always allowed in qualified mortgages, C. Points and fees are limited for qualified mortgages, or D. Qualified mortgages must have regular periodic payments? The correct answer is B. Balloon payments are always allowed in qualified mortgages. Why this can be tricky? The statement about balloon payments is misleading. Balloon payments are generally not allowed, except for certain small creditors in rural or underserved areas, making the statement inaccurate for most loans. A lender is reviewing a loan application for a 30-year fixed-rate mortgage that includes a prepayment penalty and a debt-to-income ratio of 45%. Based on qualified mortgage standards, which feature would prevent this loan from being a qualified mortgage? Is it A. The presence of a prepayment penalty, B. The loan's 30-year term, C. The fixed interest rate, or D. The debt-to-income ratio of 45%? The correct answer is A. The presence of a prepayment penalty. A prepayment penalty is generally not allowed for qualified mortgages, except in limited cases for certain fixed-rate loans, making it the disqualifying feature in this scenario. TILA, RESPA, and TRID enforcement and liability. Civil liability and statutory damages under TILA. What is the primary civil liability for a creditor who fails to provide required disclosures under the Truth in Lending Act? Is it A. Criminal penalties only, B. Statutory damages, actual damages, and attorney's fees, C. License revocation by the state, Or D. Mandatory loan rescission in all cases. The correct answer is B. Statutory damages, actual damages, and attorney's fees. Under TILA, a creditor who fails to provide required disclosures may be subject to statutory damages, actual damages, and attorney's fees. The law is designed to protect consumers by ensuring transparency in lending. Which of the following statements about statutory damages under TILA is not accurate? Is it A. Statutory damages are available even if the consumer did not suffer actual harm? B. Attorney's fees may be awarded to the consumer in a successful TILA action. C. There is no maximum limit to statutory damages under TILA. Or D. TILA civil liability can apply to both open-end and closed-end credit transactions. The correct answer is C. There is no maximum limit to statutory damages under TILA. Why this can be tricky? The question asks for the inaccurate statement, and some options may sound plausible. Statutory damages are not unlimited. TILA sets maximum limits depending on the type of transaction. Rescission penalties and extended rescission periods. Under the Truth in Lending Act, what is the primary consequence if a lender fails to provide the required notice of the right to rescind in a refinance transaction? Is it A. The loan is automatically voided? B. The lender must pay a monetary penalty only? C. The consumer's right to rescind is extended for up to 3 years? Or D. The consumer loses the right to rescind? The correct answer is C. The consumer's right to rescind is extended for up to 3 years. If the lender fails to provide the required notice of the right to rescind, the consumer's rescission period is extended up to 3 years from the date of consummation, transfer of interest, or sale of the property, whichever occurs first. Maria refinanced her home but did not receive the required TILA disclosures or notice of right to rescind. 2 years later, she wishes to rescind the loan. What is the likely outcome under federal law? Is it A. She cannot rescind because the standard rescission period has expired? B. She can rescind because the right is extended up to 3 years in this situation? Or D. She can only rescind if the lender agrees voluntarily? The correct answer is B. She can rescind because the right is extended up to 3 years in this situation. Because Maria did not receive the required disclosures, she may exercise her right to rescind the loan for up to 3 years after closing, as provided by TILA for such violations. RESPA Enforcement Authority and Penalties. Which federal agency is primarily responsible for enforcing RESPA compliance among mortgage lenders and settlement service providers? Is it A. Consumer Financial Protection Bureau? B. Federal Deposit Insurance Corporation? C. Federal Housing Finance Agency? Or D. Department of Housing and Urban Development? The correct answer is A. Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau is the main federal agency tasked with enforcing RESPA, ensuring that mortgage lenders and settlement service providers comply with its requirements to protect consumers in real estate transactions. A real estate broker receives a substantial fine after being found guilty of paying illegal referral fees to another agent in violation of RESPA. What type of penalty can be imposed for such a violation? Is it A. Only a warning letter from the regulator? B. Temporary suspension of the broker's license only? C. Civil and criminal penalties, including fines and possible imprisonment? Or D. Mandatory continuing education without any financial penalty? The correct answer is C. Civil and criminal penalties, including fines and possible imprisonment. RESPA violations involving illegal referral fees can result in both civil and criminal penalties, including fines and possible imprisonment, depending on the severity and intent of the violation.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit birdsey.ai to start your free trial of Birdsey, your AI-powered study partner.